Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 5th of December. I'm Daniel Lam, your host for the podcast. We've been talking about US equities quite frequently in the recent podcasts. Now, as the US soft landing narrative takes hold, investors would naturally be looking at how this may trickle down over to the rest of the world. And to that end, there has been some strong moves in Euro area equities lately. So let's dig deeper into this today. Now, technically, the Euro Stoxx 50 index is on a strong momentum and is likely to test the year high just under the 4,500 level. The pullback in longer-term bond yields triggered the index to rally since the end of October this year. But it is still cheap. The 12-month forward PE ratio for the Euro area equities is at a 26% discount to global equities, significantly wider than the historical 13% average discount. And the index has also been following a seasonal pattern, and it has been behaving like a typical year. And if history were to be a guide, the last 4 weeks of the year may mean more upside for European equities based on this seasonal pattern. Now, if you look at investors' positioning, this year it has also matched the typical seasonality until late third quarter, where a divergence has developed, suggesting that we could get an extra factor of quote-unquote positioning surge into year-end to close this gap, which is also bullish for Euro area equities. Now, you may ask, where would further demand for European equities come from? Well, the systematic fund inflow has already picked up quite a bit, so we would need to see participation from the long-short hedge fund community in order to extend this rally. We believe this may happen because the current positioning is very low in Euro area equities, and investors typically ramp up their net exposure in the final month of the year. Finally, it is always the economy that matters. So now, the Euro area macro data has shown some signs of bottoming out versus expectations. So typically, the average performance in the 6 weeks before the PMI drops is not so weak overall, while the initial gains after the bottoming out is strong. So it may be worth getting in slightly early in order not to miss the boat. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.